What if Bitcoin suddenly drops 70%? Sounds scary, right? But here's the real question. Would that be shocking or completely normal? Welcome to Ony Mind 3D. Today, we're not spreading fear. We're breaking down the logic behind major Bitcoin crashes, why they happen, who gets hurt, and why some investors quietly prepare for them instead of panicking. Let's start with reality. Bitcoin has crashed more than 70% multiple times in its history. In 2013, in 2018, in 2022, and every time people said, this is the end. But was it? No. Because in markets, big drops are not accidents. They are part of the cycle. Here's what most people don't understand. Bull markets create excitement. Excitement creates leverage. Leverage creates fragility, and fragility creates crashes. When Bitcoin goes up fast, new investors enter the market. Many of them buy late. They use leverage. They don't manage risk. They believe price only goes up. At the same time, something else is happening in the background. Liquidity conditions change. During strong liquidity periods, when interest rates are low and money is flowing, risk assets rise. But when central banks tighten policy, when treasury yields rise, and when safe assets become more attractive, liquidity slowly leaves the system. This is where the stablecoin and treasury relationship becomes important. Research shows that dollar-backed stablecoins hold large amounts of short-term U.S. Treasury bills. When stablecoin demand increases, billions flow into T-bills, compressing short-term yields. But when demand slows or reverses, that liquidity effect can weaken. In simple terms, stablecoins connect crypto liquidity to traditional financial markets. When liquidity is abundant, Bitcoin thrives. When liquidity tightens, pressure builds. Now add leverage to this equation. Crypto markets allow high leverage. When price drops even 10%, leveraged positions start liquidating. That forced selling pushes price down further. More liquidations follow. The drop accelerates. This is not manipulation, this is structure. And here's the part most retail investors miss. Big players don't panic during crashes. They expect volatility, they manage risk, they hold cash reserves. They understand that a 70% drawdown, while painful, is historically normal for a high-growth asset. Let's look at psychology. When Bitcoin is at all-time highs, people feel safe buying. When it drops 30%, they get nervous. When it drops 50%, they panic. And when it drops 70%, many sell at the bottom. But smart capital studies cycles. Major drops usually happen because of three forces working together. First, excessive leverage. Second, liquidity tightening. Third, emotional retail behavior. Not because Bitcoin stopped working. Now, can Bitcoin crash 70% again? Yes, it is possible. But the better question is, under what conditions? If global liquidity tightens sharply, if interest rates rise aggressively, if risk appetite collapses, if leverage positions build up too fast. Those are the ingredients. Markets don't crash randomly. They crash when structure becomes unstable. The key lesson is not to fear volatility. The key lesson is to prepare for it. Risk management is not negative thinking, it is professional thinking. Diversification matters. Position sizing matters. Avoiding emotional decisions matters. At Ony Mind 3D, we focus on financial clarity, not financial hype. Because here's the truth. Bitcoin does not destroy portfolios. Poor risk management does. Major drops are painful, but they are also part of long-term growth cycles. The investors who survive are not the ones who predict every crash. They are the ones who plan for them. So instead of asking, will Bitcoin crash 70%, ask yourself, am I prepared if it does? That mindset changes everything. This is Ony Mind 3D, where we don't chase fear or excitement, we build financial intelligence.